What if everything you've heard about reverse mortgages is wrong? In 15 years as a certified reverse mortgage professional, I hear the same 10 myths in almost every single consultation. Today I'm going to debunk every single one of them, starting with the biggest myth of all. Myth number 1, and this is the one I hear most often, is that the bank takes your home. This is completely false. When you get a reverse mortgage, your name stays on the deed from the very first day to the very last. The lender holds a lien, just like any mortgage, but you are the owner. You can renovate, you can leave it to your heirs, you can sell it any time. The bank does not take your home, period. Myth number 2, your heirs will inherit your debt. Also false. Reverse mortgages are non-recourse loans. That means your heirs can never owe more than what the home is worth when it sells. If the loan balance grew to $800,000 and the home sells for $600,000, FHA insurance covers that gap. Your kids are not on the hook for a single dollar beyond the home itself. Myth 3, you can be forced out of your home. As long as you do 3 things: pay your property taxes, maintain your homeowner's insurance, and keep the home in reasonable condition, you cannot be required to leave. The loan continues for the rest of your life in that home. The balance growing does not change that, not even close. Myth 4, you need significant income to qualify. There is no minimum income requirement for a reverse mortgage, no minimum credit score either. The financial assessment looks at your history of paying property taxes and insurance, not a W-2, not a pay stub. I work with people on Social Security every single week who qualify without any problem. Myth 5, and this one genuinely frustrates me because it costs people real money, is that a reverse mortgage is a last resort for desperate people. Research published in the Journal of Financial Planning showed that using a reverse mortgage proactively as part of a coordinated retirement strategy produced over $1 million more in long-term portfolio value compared to treating it as a last resort. $1 million. That is not desperation. That is sophisticated retirement planning. Let me run through the remaining 5 quickly. Myth 6, the proceeds are taxable income. False. The IRS classifies them as loan proceeds, not income. They do not show up on your tax return. Myth 7, a reverse mortgage affects your Social Security and Medicare. False. The Social Security Administration has confirmed it has 0 effect on your benefits. Myth 8, you must own your home free and clear to qualify. False. An existing mortgage gets paid off at closing from your reverse mortgage proceeds. Myth 9, the lender can freeze your line of credit if home values fall. False for a reverse mortgage. Unlike a HELOC, your line of credit cannot be frozen or reduced by the lender. And myth 10, reverse mortgages are predatory products. The FHA reverse mortgage has been federally insured and CFPB regulated since 1988 and requires mandatory independent counseling before any application can proceed. So where do these myths come from? Mostly from the program before 2013, when there were real problems. About 10% of borrowers defaulted on their property tax and insurance obligations. Congress passed reforms, HUD implemented a financial assessment, and that default rate dropped below 3% and has stayed there. The product that exists today is fundamentally different from what generated the negative headlines, but the myths stuck around long after the problems were fixed. Every one of these myths has prevented real people from exploring something that could have genuinely changed their retirement. Don't let a myth make your financial decisions for you. If you'd like to have an honest conversation about whether a reverse mortgage makes sense for your specific situation, visit me at reversemortgage.coach or call me directly at 7602-718646. I pick up the phone.